Hi, in this video, we will learn the journal entries to be passed at the time of dissolution of firm. Let's begin with the first journal entry. All the recorded assets such as land, building, plant and machinery, goodwill, investments, book debts or debtors, stock, bills receivable, etc. are transferred to the debit side of realization account at book values by passing the following journal entry. Realization account debit to each individual asset such as to land account, to building account, to plant and machinery account and so on. Narration being assets transferred to realization account. Please note the following assets should not be transferred to realization account: cash in hand, cash at bank, any fictitious asset such as accumulated losses or advertisement suspense, partner's loan account appearing the asset side of the balance sheet, or any debit balance of partner's capital or current accounts. These items should not be transferred to the debit side of realization account. The corresponding provision or reserve of such assets, such as provision for depreciation on fixed assets, created for the purpose of depreciation on fixed asset, investment fluctuation reserve created for the purpose of investments, and provision for bad and doubtful debts against sundry debtors. These items appearing on the liability side of the balance sheet or as a deduction from the concerned asset should be transferred to the credit side of realization account. The journal entry to be passed is provision for depreciation on fixed asset account, investment fluctuation reserve account debit, provision for bad and doubtful debts account debit to realization account. Narration being provision for depreciation, investment fluctuation reserve, and provision for bad and doubtful debts transferred to the credit of realization account. We will deal with treatment of workmen compensation reserve separately in a separate video. All external liabilities such as sundry creditors, bills payable, outstanding expenses, bank loan or any other loan, employees provident fund, and loan borrowed from any relation of a partner such as the partner's spouse, brother, sister, etc. should be transferred to the credit side of realization account at their book values. The journal entry is to debit each external liability or third-party liability separately, such as sundry creditors account debit, bills payable account debit, outstanding expenses account debit, to realization account. Narration being liabilities transferred to realization account. The following important points needs to be kept in mind. External liabilities do not include reserves and accumulated profits. These will be treated by distributing among partners' capital accounts in profit sharing ratio. The partner's loan appearing in the liability side of the balance sheet, representing the loan which is borrowed by the firm from the partner, is not an external liability and therefore it will not be transferred to realization account. This is an internal liability of the firm which has to be paid by the firm only after the payment of the third party or external liabilities. Hence, a separate account is opened and it is paid separately. The balances of partners' capital and current accounts in the liability side of the balance sheet again is not an external liability and therefore it will not be transferred to realization account. Apart from this, any unrecorded asset or unrecorded liability will not be transferred to realization account. Recorded assets and liabilities are only transferred. Recorded assets and liabilities refer to liabilities which is already there in the given balance sheet. Unrecorded assets and unrecorded liabilities, the information you will obtain from the additional information which is given in the sum. For realization of assets, that is sale of assets, the journal entry is cash or bank account debit to realization account. Narration being cash realized from the sale of asset. While passing journal entry in the narration, the realized value of each asset has to be specified. In case the asset is taken over by the partner, the journal entry is the concerned partner's capital account debit to realization account, being the asset taken over by the partner. The amount for the journal entry is the value at which the asset has been taken over by the partner. And the amount for the earlier journal entry when assets are realized in cash is the amount which is realized from the sale of the asset. Sometimes assets are given to creditors for payment of dues. For this, there will be no journal entry passed. Detailed treatment of assets which are taken over by creditors is dealt with in a separate video later on. As far as external liabilities are concerned, whether it's recorded or unrecorded, for external liabilities paid off by the firm, the journal entry is realization account debit to cash or bank account, narration being liability paid off, and the amount for the journal entry is the amount which is paid by the firm for the external liability. In case the external liability is taken over by the partner, the journal entry is realization account debit to the concerned partner's capital account, narration being liability taken over by partner. The amount for the journal entry is the value at which the liability has been taken over by the concerned partner. We need to keep in mind two very important assumptions while solving sums. Where the question is silent about the realization of any asset, such as furniture, land, goodwill, etc., which has been transferred to the realization account in the first entry, we will assume that no cash is realized and no entry will be passed for the same. However, if the question is silent on the mode of settlement of any external liability which has been transferred to the credit of the realization account, we will assume that the liability has been paid off by the firm at book value and pass the entry accordingly, realization account debit to cash or bank account. The realization expenses and expenses on dissolution of the firm, the treatment for this we will deal with in a separate video later on. The treatment will depend on who has to bear the expense, whether it's the firm or any specific partner, and who has actually paid the expense. Again, whether it's the firm or any other specific partner. So we will deal with treatment of realization or dissolution expenses in a separate video later on. Next, where there is a gain on realization or a loss on realization, it has to be transferred to partners' capital accounts in profit sharing ratio. The journal entry in the case of gain on realization is realization account debit to partners' capital account, being the gain on realization transferred to partners' capital accounts in profit sharing ratio. In the case of loss on realization, the journal entry is partners' capital account debit to realization account, being the loss on realization transferred to partners' capital accounts in profit sharing ratio. Next, we will deal with the treatment of partners' current account balances appearing in the asset side of the balance sheet or in the liability side of the balance sheet. The balances of current accounts of partners is to be transferred to their respective capital accounts. The journal entry for transfer of debit balance of partners' current account, representing the partners' current account appearing in the asset side of the balance sheet, is partners' capital account debit to partners' current account. Narration being partners' current account transferred to partners' capital account. In the case of credit balance of partners' current account, that is the partners' current account appearing in the liability side of the balance sheet, the journal entry for the transfer will be partners' current account debit to partners' capital account. Narration being the credit balance of partners' current account transferred to partners' capital account. The treatment of accumulated reserves, profits or losses and also fictitious assets is the same as in the case of reconstitution of firm. Accumulated reserves and accumulated profits needs to be distributed among partners' capital accounts in profit sharing ratio by passing the entry general reserve or reserve fund account debit, profit and loss account debit to partners' capital account. Narration being reserves and accumulated profits distributed amongst partners in profit sharing ratio. For writing of accumulated losses and fictitious assets, the journal entry is partners' capital account debit to profit and loss account or to advertisement suspense account or to deferred revenue expenditure account. Narration being the accumulated losses and the fictitious assets written off amongst the partners in their profit sharing ratio. For the payment of partners' loan, we are talking of the loan which the firm has borrowed from the partner, which is an internal liability. It will be paid off separately. The journal entry being concerned partner's loan account debit to cash or bank account. Narration being loan from partner borrowed, paid off by the firm. Treatment of partner's loan account where the partner's capital account has a debit balance we will deal with later in a separate video. The treatment of partner's loan account appearing in the asset side of the balance sheet. We are talking of the loan which is advanced by the firm to the partner. We will close this partner's loan account by transfer to partner's capital account. The entry to be passed is partner's capital account debit to partner's loan account. Narration being partner's loan account transferred to partner's capital account. The final entry is for final settlement to partners. Where the firm owes cash to the partner, the journal entry is concerned partner's capital account debit to cash or bank account, narration being final settlement. Where the partner owes money to the firm and has to bring in cash, the journal entry is cash or bank account debit to the concerned partner's capital account, being final settlement. So in this video, we've learned and gone through all the journal entries that have to be passed at the time of dissolution of partnership firm.